Hey there, Tad. How are you this week?
Doing great.
Well, good. Always a pleasure to talk with you. Again, folks, Tad Hill, our local trusted advisor right there in the Birmingham area. Tad, obviously, anybody can tell there's been a lot of volatility in the markets here the last couple of weeks. What do you think people need to be paying the most attention to or thinking about the most?
Well, it's a great question. And, since the election, there's been a huge sell-off in the markets. I think some of that is a reaction to Obama getting reelected. I think a lot of it is a reaction to the fact that the tax laws are going to be changing. So unless Congress acts, there's going to be a significant change in the way dividends and capital gains are taxed. So I think a lot of people are taking their gains now in anticipation of higher tax rates moving forward. I think that's a lot of what's causing it, those two things combined. But really, it gives us an opportunity to illustrate a key retirement planning point. And here's what that point is. Markets are going to go up and markets are going to go down. What happens when things are going well and everybody's feeling good about the direction of the markets is we tend to forget that the flip side of that is going to happen at some point. And if we're 30 or 40, that's not a problem. We've got our paycheck coming in. But when we get near retirement or we're in retirement, the thing that trips people's plans up the most is that their plan is structured so that it's only going to be successful when the markets are going up. And let me ask you, do you think the markets are going to go up every year?
Well, I would think over the period, like a long period, sure, they're going to go up over the long haul, but you can't guarantee that they're going to go up every single year, no.
Yeah, I mean, we've seen in the last dozen years that really we haven't gotten hardly any gain in the markets, and we've had some pretty bad years in there, 2 periods of time where the market was down 50%. And if you're taking money from your portfolio at the same time, it just exacerbates the problem. One thing you have to be aware of, you need to know how much downside risk is actually in your portfolio. One of the things our process does when we go through our roadmap review is we tell you with your holdings in your portfolio, how much downside risk is in your portfolio with your current holdings. And when I ask people this question, if we go through another 2001 and 2002 or another 2008, how much are you comfortable losing? And what do you think their answer is most of the time?
Most people say, I don't want to lose anything.
Right. That's exactly right. I don't want to lose anything. And I say, okay, well, then let's talk about this. 80% of your investments are in the stock market, and you are clear that that means at some point you will be losing money. And they go, well, yeah, I know. So I mean, people understand that if you're in the markets, you're running the risk of losing money. But when I say, okay, so realistically, you're invested in a way that can go down, yes, I do. All right, so let's ask the question, how much downside are you comfortable with? If you're down 10%, are you okay? If you're down 20%, are you okay? At what point do you get into that place where you're losing sleep at night? And oftentimes, the range that I tend to get the most is somewhere between 10 and 20%. Some people are okay. If you've got $1 million being down 100,000, you're okay. But if you're down 200, you start to get really nervous. And so we do an analysis of, with your holdings, how much downside do you have? And would you be surprised, John, to find out that over 80% of the time people have significantly more downside than not only are they comfortable with, but than they knew they had. It's one thing to be taking risk you're taking. It's a completely different thing to be taking risk you aren't even aware you're taking. Would it surprise you to find that out?
I guess it wouldn't surprise me that much, but I'm guessing that they're usually pretty surprised when they find that out.
They're very surprised. And do you know why? The reason they're so surprised, here's some variation of this conversation happens most of the time. Wow, I had no idea. After 2008, I sat down with my broker, and I told him I don't want that to happen again. And so when we do the analysis, it's normally a big surprise to people. The The other thing is when I say, okay, how are you designed to replace your paycheck? Because that's really what retirement planning is about. Once we quit working, how do we replace our income? How do we handle this 25 years of unemployment called retirement? We have to replace the income. And so oftentimes when we analyze people's portfolio, and this is another thing our review process does, how are you structured to generate your paycheck? Are you structured to generate your paycheck in a way that's secure and predictable? Or is it based upon something that we know is going to shift underneath our feet? And again, would it surprise you to find out that most people's investments are structured in a way where their income is only going to be generated in the years where we're getting growth in the markets? Would you be surprised by that?
Maybe a little bit, yeah.
It's surprising to me, frankly, how often that's the case. People come in and I say, okay, well, how are you structured to generate your paycheck? And they say, well, I know my broker has put me in I've got a few bond funds and I've got some dividend paying stocks, and I think overall, that's the strategy. And so when we look at it and we look at how much income is being generated from these things as a percentage of the overall portfolio, again, that's something our review does. One of the things we're looking at is how much income is being generated. And if I see a portfolio with less than 4% being generated in interest and dividends, then what that tells me is we are structured in a way where we're only going to be successful if the markets are going up. And so these are the kinds of questions that we have to understand. Otherwise, we're really flying blind. If I ask you, how much downside is there? How is your portfolio structured to replace the income, even if the markets aren't behaving the way we want them to? And if you're unsure of the answers, chances are you're not structured in a way to take care of that. And that's really a real fundamental challenge that so many people have. If you're listening and you're questioning these things for yourself and you're not sure if your strategy is going to be successful regardless of which direction the markets go, but you would like to have one that is, be one of the first 5 callers, and I'll set aside time on my calendar so that you can receive completely free our retirement roadmap review. We do require that you have a minimum of $250,000 of investable assets, but if so, I'm willing to do this at no cost and no obligation to you. The review takes place in our office right here in Indian Springs on the corner of Valleydale and Caldwell Mill, but the purpose of this review is to understand how things are structured today, to answer questions about what you're actually going to need from your savings. A lot of times people aren't even clear on how much we need to generate to replace their paycheck. This review process will answer that. The good news is once we're done, you will have a tremendous amount of peace of mind knowing where you stand, what needs to happen to secure and protect your retirement, and the things that you can do to do that. So our process is designed to expose any risks that you have and to eliminate or mitigate those risks as much as possible. So if you would like to know the answers to those questions for yourself, be one of the first 5 callers. I'll set aside time on my calendar to sit down and get these answers for you. We do require that you have a minimum of $250,000 of investable assets, but if so, I'm happy to make this offer completely free with no obligation.
And the number to call is 800-929-4077. 800-929-4077. It's your chance, whether you're a retiree or a pre-retiree, your opportunity to get some common sense and straight talk. Let Tad take that complex financial world and really break it down into very clear instructions for you. Again, 800-929-4077 is the number to call.